I want you to think about something right now.
Just imagine you get tasked with building a global manufacturing empire.
Right, an absolute juggernaut.
Like the kind of industrial machine that just totally dominates the late 20th century.
Exactly. You're exporting precision engineering to every corner of the planet.
Yeah.
Your chemical plants are unparalleled. Your automotive brands are universally respected.
Everyone knows your name.
But here is the massive contradiction at the heart of your empire. Your stock market.
Oh, it's practically a ghost town.
It did.
Yeah, completely quiet. The trading floors just, lack that frantic energy we always associate with modern capitalism.
So how is that even mathematically possible? I mean, the entire Western world operates on this one specific assumption.
Right. The assumption that to build a global powerhouse, you absolutely need a frenzied, hyperactive stock market.
You need Wall Street.
You need Wall Street.
You need constant high-volume trading.
Yeah.
And crucially, you need the constant threat of hostile takeovers.
Yeah, keeping CEOs awake at night.
Right, forcing them to be ruthlessly efficient.
That is the standard narrative. It's the core of the Anglo-American rulebook. Economists call it the outsider system of corporate governance.
The outsider system.
Yeah. Where you have dispersed shareholders constantly buying and selling, and that forces management to maximize share price or, face total annihilation.
But late 20th century Germany proved everyone wrong.
Completely wrong.
They built the ultimate industrial machine on a financial foundation that just totally defies that rulebook.
It throws the rulebook out the window.
So today, we are taking a deep dive into the shadowy inner workings of German corporate power.
We're looking at a milestone piece of research here.
Right. Published in 2001.
In the Review of Financial Studies. It was written by Julian from the London Business School and Colin from the University of Oxford.
And if you have ever wondered how the ultra-wealthy actually control massive corporations without, risking a proportionate amount of their own money, you need to hear this.
Oh, absolutely. Franks and Mayer mapped out this financial architecture that most people didn't even know existed.
It's crazy.
Their work completely upended how the academic world understood free markets.
Because Western economists looked at Germany's success and just assumed there had to be some hidden, highly efficient public market mechanism driving it.
Right, and Franks and Mayer proved there wasn't. Germany operated on this fiercely guarded insider system, a totally closed loop.
So let's unpack the core paradox here. In the 1990s, German manufacturing is just sweeping the globe.
Unstoppable.
Yet their public markets see virtually no hostile takeovers.
Almost none at all.
Which is wild. If you look at the UK or the US at that exact same time, it's the era of the corporate raider.
Oh yeah, Gordon Gekko style.
Anyone can buy your stock.
Yeah.
Anyone can launch a hostile bid. Management is constantly playing defense.
It's a brutal, transparent arena.
But in Germany, it's like finding out the world's greatest sports team doesn't even practice in public.
They just show up, shut out the noise, and win.
Right. How do they maintain elite efficiency without that constant external threat?
Well, for decades, that German power maze was just a black box. You couldn't just look at public stock charts.
Because the charts don't tell you the real story.
Exactly. Public charts tell you very little in an insider system. Franks and Mayer had to really dig into the plumbing.
They had to get their hands dirty.
They analyzed proxy votes. They mapped hidden ownership layers. They tracked private block trades across 171 large German quoted companies.
They basically mapped an invisible labyrinth.
Yeah, they did.
And to understand just how alien this system is, we need to look at the raw numbers.
The numbers are staggering.
Because if you grew up in the US or the UK, you just think the stock market is a universal concept.
You think it works the same everywhere.
But it doesn't. The structural numbers between Germany and the UK at that time, they don't even look like they belong on the same planet.
Let's compare them directly. In 1990, the UK had nearly 3,000 quoted companies on their main stock exchange.
3,000. A massive, bustling marketplace. Companies going there to raise capital from the public.
Right. And Germany. For an economy of comparable, if not greater, industrial weight.
What was their number?
Germany had fewer than 800 quoted companies.
Under 800. That is a slap in the face. That alone is a staggering difference in how businesses choose to fund themselves.
It is, but the real shock is who actually owns those few public companies.
Okay, let's get into that.
In the UK, if you look at their largest companies, Only 13% had a single shareholder owning more than 25% of the stock.
13%.
Yeah.
So that means the vast majority of UK companies are owned by this massive, chaotic crowd of retail investors, mutual funds, pension funds.
Exactly. Nobody has absolute unilateral control. The power is totally dispersed.
Now look at Germany.
A massive 85% of their largest companies had a single shareholder controlling over a quarter of the votes.
Great. 85%.
85%.
That is not a free market as we understand it.
No, not at all.
That is basically a collection of corporate fiefdoms.
But hold on. If 85% of these massive industrial firms are controlled by mega block holders,
Yeah.
isn't that just a recipe for dictatorship? Like, does this extreme concentration actually protect the company from short-term greed? Or does it just breed massive internal plunder?
That is precisely the question Franks and Mayer set out to answer. Because in the Anglo-American model, if one person holds all the cards, they tend to enrich themselves.
At the expense of everyone else.
Exactly. So to figure out if that was happening in Germany, we have to look at who these mega shareholders actually are.
And how they hide their power.
Right, because the true rulers of German industry, they don't hold their shares directly.
No, they build fortresses.
Fortresses. We aren't talking about standard holding companies here. We are talking about deeply complex, multi-layered pyramid.
And cross-holding.
Yeah, a dense web of intercorporate holdings.
Yeah.
And at the very top of these pyramids, hiding behind multiple layers of legal entities, are the real power brokers.
Families and banks. Families controlled about 33% of ultimate holdings. Banks controlled another 12%.
Okay, walk me through the actual mechanics of a financial pyramid. How does it function legally?
Think of it as a cascading series of legal structures. They're designed to amplify control while minimizing investment.
Okay.
So Company A sits at the top. Company A owns a controlling stake, let's say 25% in Company B.
Got it.
Company B, in turn, owns a controlling 25% stake in Company C.
Right.
And Company C is the operating firm. They actually own the factories and produce the goods.
So it's institutionalized leverage.
Massive leverage.
But how exactly does this let someone at the top control the massive empire at the bottom using barely any of their own money?
Let's use a concrete example from the study to make this real. The perfect example is Daimler-Benz.
Oh, wow. The makers of Mercedes, one of the crown jewels of German manufacturing.
Exactly. In the early 1990s, Daimler-Benz was the bottom layer of a staggering 4-layer pyramid ownership structure.
Okay, let's descend into this labyrinth layer by layer.
At level 1, you have the operating company, Daimler-Benz AG.
Right.
25% of Daimler-Benz was owned by a holding company called Mercedes Automobile Holding.
So Mercedes Automobile Holding has what German law considers a blocking minority.
Right. They have enough voting power to veto major strategic decisions.
They have massive influence. But who owns them?
That takes us to level 2. 25% of Mercedes Automobile Holding was owned by another entity called Stern Automobile.
Another blocking minority. So whoever controls Stern controls Mercedes, which controls Daimler.
You're tracking. Now we move up to level 3. 25% of Stern Automobile was owned by Robert Bosch GmbH.
Oh, the famous engineering company.
The very same. Robert Bosch sits at the top of this multi-tiered waterfall. They hold the ultimate reins.
But let's look at the math here, because this is where it gets insane. Let's calculate Bosch's actual cash flow rights in Daimler-Benz.
Cash flow rights are crucial. They represent the actual percentage of their own money they have tied up in the bottom-tier company.
The real financial risk they are taking.
Right. And to find it, you multiply the stakes down the chain.
So it's 25% of 25% of 25%.
The math is brutal.
The financial exposure dilutes instantly with every single layer.
It does. When you run the numbers, Bosch's actual cash flow return rights in Daimler-Benz were exactly 1.56%.
1.56%.
That's it.
They put in almost nothing relative to the size of the total enterprise.
Barely anything. But because of the pyramid structure, because every single layer represents a 25% blocking minority that dictates the actions of the layer below it,
Yeah.
Bosch effectively wielded 25% of the voting power at the shareholder meetings of Daimler-Benz.
Wait, that is a 16-to-1 ratio of power to risk?
16-to-1.
They legally isolated themselves from financial ruin while keeping their hands firmly on the steering wheel.
They took the golden rule of capitalist equity One share, one vote, and they smashed it.
Totally smashed it. They wielded massive strategic influence over a global automotive titan while holding just a microscopic fraction of the financial risk.
Exactly.
But wait, I have a question. If Bosch's cash flow rights are only 1.56%, why wouldn't the other shareholders, the ones who own the vast majority of the actual equity, just gang up and outvote them?
That's a great question.
Like, what legally allows Bosch to amplify that tiny stake into absolute dominance?
It comes down to how German corporate law treats that 25% threshold. It's called a blocking minority.
Blocking minority, okay.
Under German law, major corporate decisions, like changing the company's charter, approving major mergers, raising capital, they require a 75% supermajority at the shareholder meeting.
So if you hold 25% plus one share, you have an absolute veto.
Precisely.
You can paralyze the whole company if they don't listen to you.
You don't need 51% to be the boss. You just need enough to block everyone else.
That is wild.
And by stacking these blocking minorities through holding companies, Bosch engineered a situation where their veto power cascaded all the way down to the factory floor.
You know, this structure seems incredibly predatory.
It really does.
Like, if I am a retail investor in Daimler-Benz, I am putting up the real capital, I'm taking the real risk, but my vote means absolutely nothing.
Nothing at all.
Because this engineered pyramid above me dictates all the terms. Was everyone in Germany using this pyramid magic to rule like tyrants?
Well, that was the prevailing assumption in the academic literature at the time.
It makes sense.
Western economists were convinced these pyramids were designed purely to oppress small investors and extract wealth. I mean, why else would you build a 4-layer corporate nesting doll?
Right. But the data tells a different story, doesn't it?
This is where Franks and Mayer drop a major revelation.
Hit me.
They didn't just assume the pyramids were malicious, they actually tested them. They analyzed 38 companies with multiple layers of shareholdings. They looked closely at 33 distinct pyramids, and they calculated the exact math on every single one.
They were looking for the gap.
Exactly, the spread between cash flow rights and voting rights.
To see if they were crossing that control line.
They wanted to see how many of these pyramids actually crossed a critical control threshold, like 25% for a blocking minority or 50% for a majority, specifically because of the pyramid structure.
Meaning, how many were actively weaponizing the structure to seize control they hadn't paid for?
Right.
I would assume all of them. That seems to be the only logical reason to pay lawyers millions to set up such a complex web.
You'd think so.
Yeah.
But out of those 33 pyramids, only 10 actually crossed a critical control threshold, where the voting rights massively outstripped the cash flow rights to seize power.
Wait, really? Only 10?
Just 10.
That means roughly 2/3 of these complex pyramid structures were not being used as aggressive control weapons.
They showed incredible restraint.
That is another slap in the face to our intuition.
Totally. When Franks and Mayer dug into the history, they found that often these structures were just historical artifacts.
Like what?
Old holding companies, legacy joint ventures, remnants of post-war restructuring. They were not malicious vehicles designed to systematically rob the minority shareholder.
Okay, so the families and the banks at the top aren't necessarily evil geniuses pulling strings for pennies.
Not always, no.
In many cases, the pyramids were just benign corporate plumbing. But that raises an even bigger question for me.
What's that?
If the mega shareholders aren't using these structures to relentlessly hold managers' feet to the fire,
Yeah.
how do they supervise the CEOs?
Well, basic economic theory, specifically agency theory, tells a very simple story.
Which is?
If you own a massive concentrated chunk of a company, you are highly motivated to watch the CEO like a hawk.
That makes intuitive sense. If I own 25% of a multi-billion-dollar chemical plant, I am calling the CEO every single morning.
You'd be very invested.
If profits dip, if they make a bad acquisition, I fire them. It is my wealth on the line. I am the ultimate monitor.
Ownership concentration equals better monitoring. That is the bedrock intuition of corporate finance.
Right.
But Franks and Mayer shattered that intuition completely.
They tested it directly against the German data.
They did. They looked at companies with concentrated ownership, closely held firms with massive block holders.
Okay.
And they compared their behavior to widely dispersed companies, firms owned by thousands of small investors with no dominant boss.
Okay, so if agency theory is right, the closely held companies should fire bad managers way faster.
Exactly. They have a big boss in the room with the power to act.
While the dispersed companies just have this Disorganized crowds suffering from the free rider problem. Nobody wants to pay the legal fees to launch a proxy fight against the CEO.
That's the theory. Yet when they looked at the actual turnover rates for the management boards,
Yeah.
the firing rates were practically identical.
Identical? Are you serious?
Yeah. Almost exactly the same. Having a giant mega shareholder hovering over the company did not make management any more likely to get fired when things went bad.
That defies all logic.
The difference in turnover between the closely held firms and the widely dispersed firms was less than 1%. It was statistically meaningless.
That is like saying hiring a massive armed security guard for your store doesn't stop shoplifting any better than just leaving the front doors wide open.
Pretty much.
If the big bosses aren't driving the supervision, who is? I mean, why are these mega shareholders even there if they don't execute their primary function of firing bad CEOs?
To understand that, we have to look at how German companies actually punish failure. Because they do punish failure. Brutally. But they use a completely different trigger. They don't care who owns the shares. They only care about the accounting.
The red line.
The cold, hard reality of the profit and loss sheet.
So when a German company starts losing money, the guillotine drops. It is automatic.
Exactly. Franks and Mayer looked at management board turnover in relation to corporate earnings.
What did they find?
In the years before a company reported an earnings loss when they were profitable, the average turnover of the management board was a modest 6.6%.
6.6%. Okay, that's just normal attrition. Executives retiring, moving to other firms. It sounds very stable.
It is stable. But in the year of an earnings loss, and the years immediately following, that turnover rate jumps to a staggering 13.5%.
It basically doubles.
It doubles.
The second the company dips into the red, heads roll.
And if the losses are persistent, like if the company bleeds money consecutive years in a row, the punishment accelerates.
The supervisory board steps in,
Yeah.
and the purge widens.
Yes. The system is brutally efficient at removing mediocrity, but the trigger is entirely financial.
Okay, so the discipline mechanism works. Bad managers do get fired, but we just established that the concentrated mega shareholders aren't the ones driving this.
Right.
The concentrated owners don't fire people any faster than the dispersed owners.
They don't.
So who actually presses the fire button when the company crosses that red line?
Franks Mayer used a complex regression analysis to isolate the exact variables that cause a CEO to lose their job.
Okay, let's look at the math. This strips away all the corporate mythology and looks purely at mathematical cause and effect.
Exactly. What did the model show? First, they tested earnings losses. The coefficient was 0.105, and it was highly statistically significant.
Profit goes down, CEO goes out. The data confirms the red line.
Right. This proved definitively that reporting a financial loss directly causes management firings.
Okay, but what about the big bosses?
Then they added an interactive term. They mathematically mixed ownership concentration with the earnings losses.
An interactive term. So they essentially asked the computer model, does a loss-making company fire its boss faster if it has a mega shareholder in the boardroom?
That's the question. And the model said,
What did it say?
the statistical significance vanished completely. The coefficient for that interactive term was 0.000172. It was mathematically flat.
A total flat line.
It proved beyond a shadow of a doubt that ownership concentration does not improve supervisory efficiency.
So it doesn't matter if the company is owned by a powerful industrial family, another massive corporation, or just a bunch of random retail investors.
This doesn't matter at all.
When the company loses money, the manager is out. The governance mechanism is tied to the balance sheet, not the shareholder registry.
Exactly.
That is fascinating, but it leaves a massive mechanical hole in our understanding.
How so?
In a closely held company, I can see how the board fires the CEO. The family tells the board what to do.
Sure.
But in the widely held companies,
Yeah.
the ones without a massive family boss who is organizing the firing,
Right.
who's actually wielding the axe in a dispersed company, there's no one boss to coordinate it.
This is where we meet the shadow masters of the German economy, the universal banks.
Institutions like Deutsche Bank, Dresdner Bank, and Commerzbank.
When a company's shares are dispersed among thousands of small retail investors, a power vacuum forms.
Right, because nobody has enough votes to matter.
And the banks step right into that vacuum. But they don't do it by spending billions to buy all the stock themselves.
They use a much cheaper, much more pervasive tool.
Proxy votes.
Proxy votes.
Exactly. The German system relies heavily on bearer shares. These aren't registered to a specific person's name on a digital ledger,
They're physical certificates.
physical pieces of paper. And for safety and convenience, regular German citizens deposit these physical shares in their local bank vaults.
And when a retail investor drops off those shares, they sign a standard form giving the bank the right to vote on their behalf at the annual shareholder meetings.
It's called Deposstimmrecht. The banks harvest these proxy votes by the millions.
Millions of them.
Franks and Mayer looked at a data set of 49 widely held companies.
Okay.
They found that just 3 megabanks, Deutsche, Dresdner, and Commerzbank, wielded an average of 14.4% of the total proxy voting power.
They control over 14% of the entire company's voting block without owning a single share of it.
Immense power granted by default.
Plus, the banks do hold about 6.8% of their own direct shares in these companies as investments.
So you add those two pools of voting power together.
14.4 plus 6.8. Together, these three banks control over 17.6% of the voting power at shareholder meetings.
They sit in the room like absolute titans.
Over 17% is massive. They must hold the seats on the supervisory boards.
They do. They often appoint the supervisory board chairman. They act exactly like dominant owners, but they are voting with other people's ballots.
So if these banks hold all this concentrated power in the dispersed firms, are they acting as the ultimate protectors of the little guy?
That's the hope. Well,
Do they use this massive borrowed proxy power to crush bad managers when the company crosses the red line? Because a single retail investor with 10 shares isn't going to fight the CEO.
no, they can't.
But Deutsche Bank, with 17% of the vote, they could clean house in an afternoon.
Everyone in the West hoped the banks would be the heroes of this story. Academics theorize that the banks would overcome the free rider problem of the small investors and aggressively police corporate governance.
But once again, the data gives us a massive contradiction, doesn't it?
The illusion of governance, the black hole of proxies.
Oh,
Franks and Mayer ran their regression analysis again, this time isolating the bank proxy power instead of family ownership.
to see if massive bank proxy power increased the firing rate of bad managers.
Exactly. And the result?
What was it?
0. The presence of massive bank proxies had absolutely zero significant impact on firing bad managers.
You're saying the banks sat on their hands.
Entirely.
They did nothing.
When companies lost money, the fact that a mega bank held 20% of the proxy votes did not increase the firing rate at all compared to a company without bank involvement.
Wow.
They did not use this massive concentrated power to punish underperforming CEOs.
Hold on. This makes no sense.
I know.
If the banks hold all the cards, but they refuse to play them when the company is failing, what are they actually doing?
Right.
What is their role in this whole ecosystem? Are they just showing up to the annual meetings to eat the catering and collect board fees?
They aren't playing the public governance game. They are playing a much deeper, quieter game under the surface.
Okay.
A game of pure, concentrated capital exchange. We're moving into the undercurrents now.
The staggering scale of block trades.
Yes. When people hear that Germany has virtually no hostile takeovers, they assume the German market is a dead, stagnant pond.
A frozen corporate landscape where nothing ever changes and the same families rule forever. That would be the logical assumption.
No Wall Street raiders means no movement,
Right,
but
yeah.
you would be dead wrong. It is not a pond. It is a raging underground river.
Okay, I love that analogy. Explain it.
The public market is quiet, yes, but the private market for corporate control is incredibly fierce.
How does that work if there are no public takeovers?
Through a massive, highly active market in private block trades, massive controlling chunks of companies are sold behind closed doors.
Ah. So there are no public tender offers, no screaming headlines on the financial networks.
Exactly. Just two billionaires or two holding companies or a bank and a family swapping ultimate power in a back room.
How big was this underground river? Let's put some scale to this.
Franks and Mayer calculated the annual turnover of these giant share stakes. It was over 8% per year.
8% of the corporate sector's control changing hands annually. Let's benchmark that.
Let's do it.
In the UK, during the absolute peak of the 1980s hostile takeover boom, the era of Gordon Gekko, when corporate raiders were on the front page of every newspaper every single day, what was their turnover rate?
4%.
4%.
Yep.
Germany's quiet, secretive, backroom market for corporate control was twice as active as the loudest, most aggressive hostile takeover market on Earth.
It was incredibly dynamic. Over a 3-year period in their sample, 21.6% of German companies saw a totally new major shareholder emerge.
Controlling stakes were just passed around like poker chips.
Exactly.
But wait, if they're passing these massive controlling stakes around in secret, who is actually winning?
What do you mean?
If there is no public auction, no public bidding war, driving up the stock price for everyone who gets the money.
This is where the German system reveals its darkest structural flaw for the average investor.
Oh, no.
It's about the private benefits of control and how the law allows those benefits to be completely torn away from the minority.
Okay, let's compare the rules of the game here. In the US and the UK, if someone wants to buy control of a public company, the law forces them to share the wealth with everyone.
Right. It's called the equal price rule or the mandatory bid rule.
Exactly. So if a corporate raider wants to take over a UK company and they privately pay the founder a massive 20% premium for his controlling block of shares, the law says the raider must immediately offer that exact same 20% premium to every single small retail investor who holds the rest of the stock.
It democratizes the takeover premium.
It ensures that the massive windfall of a corporate buyout is shared proportionally with the public. But in Germany in the 1990s,
Germany had no such rule.
none.
None at all.
So the elite feast and the small investors starve.
Legally, a buyer could walk up to a massive block holder, pay them an absolute fortune for control of the company, and offer the small minority shareholders absolutely nothing. Zero.
They didn't even have to buy the minority shares.
Not a single one. It is institutionalized price discrimination.
It is sickening.
Economists refer to this as the extraction of private benefits of control.
Private benefits. Yeah.
The power to dictate terms in a German company, to appoint the board, direct the cash flow, decide on mergers, is so immensely valuable that buyers will pay massive premiums just to the person holding those specific keys.
And because the law doesn't force them to, they don't share a dime of it with the public.
Why would they? Let's put a hard number on this financial inequality. Franks and Mayer measured the premium chasm, didn't they?
They did. They analyzed 57 massive block transactions. They tracked the prices privately paid for these chunks of power and compared them to the public stock price.
How big were these blocks?
The average size of the chunks sold was over 36% of the company.
A massive, undeniably controlling block.
And what did the seller get?
The elite block holders walked away with an average control premium of 13.85% over the public market price.
Nearly 14% extra cash just for being the boss. And what about the ordinary minority shareholders?
The retail investors holding the other 64% of the company.
Right. What happened to their stock price when this massive transformative change of control was announced to the public?
Their abnormal return was statistically dead flat.
Flat.
Over a 3-month window around the announcement of the deal, the return for the minority shares hovered between negative 0.69% and positive 1.45%.
It didn't move an inch. They got exactly zero benefit.
A total wealth diversion. The premium existed only for the elite.
The buyer paid millions in extra premium to the old boss, took over the entire direction of the company, and the public stock chart just flatlined. Look, if I'm a minority shareholder and I see the founder cash out for millions in secret premium, while my life savings don't see a single cent of that upside, I am calling my lawyer.
You'd be furious.
How is there not a riot in the streets? How do small shareholders tolerate a system so brazenly stacked against them?
They couldn't riot because legally they were invisible in these transactions.
Invisible.
This is the minority curse of the German system. Because there was no mandatory equal offer rule, buyers and block holders privately negotiated the price of control entirely in the shadows.
So the data conclusively proves that the private benefits of control in Germany were vastly disproportionate compared to the Anglo-American world.
Vastly. The system was basically designed to allow the titans to trade empires without ever having to compensate the peasants living on the land.
That is just brutal. But, this raises a fascinating operational paradox for me.
What is it?
If you are a new buyer, say a billionaire industrialist or a massive conglomerate, and you just paid a massive 13% premium to buy a controlling 36% stake in a new company.
Yeah.
What is your next move? I mean, if I just spend a fortune buying control, I need to see a return on my investment. I didn't buy it just to look at it.
Obviously.
I walk in on day one, I fire the underperforming managers, I restructure the whole company, I integrate their supply chain with my other businesses, and I make it hyper-profitable.
Right. Wrong.
What?
Why? Welcome to the nightmare of the German legal wall.
Okay, this is where the raiders become dancers in shackles. Break this down for me.
In America, a corporate raider walks in, fires the board, and guts the company before lunch.
Right.
In Germany, the new owner walks in, holding their 36% or even 60% stake, and immediately hits a brick wall of institutional barriers.
They are completely paralyzed. Break down these barriers. Why can't a majority owner just do what they want?
First, the minority shareholders.
But wait, you just said they were invisible.
They are powerless when it comes to the takeover premium, but German law gives them a very specific, incredibly annoying weapon after the fact. It's the arm's length rule.
How does that work?
Let's say you buy 75% of a company. You want to integrate it into your wider empire. You want company A to buy cheap supplies from your new company B.
Standard synergy play.
The remaining 25% minority can sue you.
Sue me for what?
They can legally demand that all transactions between your companies be strictly at arm's length, meaning standard, verified market prices.
So I can't just absorb the company, share resources, and create synergistic efficiencies.
No, the minority will drag you into court, audit every invoice, and claim you are tunneling wealth away from them. They turn integration into a legal nightmare.
So barrier 1 is minority lawsuits. What's barrier 2?
Squeezing out that minority. In the UK, if a buyer hits 90% ownership, the law allows them to force the last 10% to sell.
You squeeze them out, take the company totally private, and then you can do whatever you want without the arm's length rule. Clean and simple. But in Germany,
Remember the bearer shares? The physical certificates sitting in bank vaults.
oh right, because the shares aren't registered to names, you literally don't know who owns the last 10% of your company.
The banks know who deposited them, but they won't tell you.
That is maddening. So you can't easily identify the minority to squeeze them out.
And even if you miraculously cross the 95% threshold required for a compulsory buyout under German law, any single shareholder can tie you up in court for years arguing that the buyout price you're offering is unfair.
Okay, barrier 3, the board itself. I buy the company. I want to fire the CEO who is causing the stock to underperform.
You can't.
What do you mean I can't?
German companies have a two-tier board system. The supervisory board appoints the management board, and both boards are appointed for fixed legal terms, usually up to 5 years.
5 years.
You literally cannot fire them just because you bought the company. You have to wait for their contracts to expire, or you have to pay them massive negotiated settlements to leave voluntarily.
So what happens when unstoppable capital meets this immovable German system? Let's look at some real-world examples.
Franks and Mayer detail 3 massive hostile battles, 3 bloodbaths from the data: Pirelli versus Continental in the tire industry, Krupp versus Husch in steel, and Wiebe versus Feldmühl.
Let's start with Viva. What happened there?
Wiebe wanted to take over Feldmühl, a major paper and packaging company. They spent a fortune in the Underground River. They bought up massive private blocks from the old owners, the Flick brothers.
Okay,
They successfully acquired a staggering 61% stake.
61%. They own the clear majority. They own the company.
They owned the shares, but they were entirely paralyzed. The Flick brothers had left booby traps, fighting them every step of the way. And worse, 3 tiny minority shareholders sued Wiebe in court.
3 guys with a handful of shares.
3 shareholders. They used the legal system to challenge the integration, and they successfully dragged the merger out for an entire year.
Wiebe held 61% of the equity and legally blocked from changing the management or integrating the business operations. That is insane. What about Pirelli and Continental? That was a massive cross-border fight.
Pirelli, the Italian tire giant, wanted to take over Continental. They bought massive support. They actually got 66% of the shareholders to back their takeover plan.
So they won.
Well, Continental had a corporate rule, a poison pill that capped anyone's voting power at 5%, regardless of how many shares they actually owned.
Wait, so Pirelli has 66% of the equity, but their vote is capped at 5%.
Yes.
And they demand the cap be removed so they can exercise their true majority. What happened?
The German banks stepped in. The banks used their massive blocks of proxy votes, the votes from thousands of retail investors who had left their bearer shares in the vaults and sided with Continental's entrenched management.
You're kidding.
They voted to keep the voting cap. They blocked Pirelli entirely.
Pirelli lost a fortune in the attempt and ultimately had to retreat. The banks protected the insider management against a majority shareholder.
It happens. And what about Krupp versus Husch?
Tell me.
Krupp secretly bought up 62% of Hoche, again, a massive, undeniable majority, but they couldn't complete the merger for a year.
Let me guess. Minority lawsuits.
Once again, a tiny minority of shareholders invoked their legal rights, demanded investigations, and used the courts to freeze the integration.
It's like buying a house, paying millions for it, moving in, and the old tenant tells you that by law, you aren't allowed to change the furniture or the locks for 3 years, and your own bank is funding the tenant's legal defense.
The transaction costs of changing control are astronomical.
So because of these insane legal hurdles, what actually happens to a company's performance after one of these massive block trades?
This brings us to the most counterintuitive finding of the entire study, the reversal: governance failure after block trades.
You would assume that new ownership brings a cleansing storm. A new billionaire buys a 36% controlling stake, they eventually fight through the courts, they take control, and they demand excellence. They purge the bad managers to recoup their premium.
The reality: the market for corporate control in Germany actually protects the incompetent.
This is the ultimate anti-common sense moment. Explain the math here.
Franks and Mayer went back to their regression model. They checked the firing rates for loss-making companies, the red line.
Right. Earlier, we established that if a company crosses into financial losses, the firing rate jumps to 13.5%. And if ownership is completely stable, no block trades, what is the firing rate when they lose money?
In companies where ownership was stable, a financial loss resulted in a 20.9% firing rate for the management board.
That is a brutal, efficient purge.
Yeah.
Over 1 in 5 executives fired immediately. But what about the companies that recently had a massive block trade? The companies that just got a new, aggressive billionaire owner?
In those newly acquired companies, the firing rate for loss makers dropped to 14.0%.
It dropped. Changing ownership actually weakened the punishment for bad management. How is that even possible?
Think about the trench warfare we just discussed.
The lawsuits.
The chaos, the legal fights, the minority shareholder lawsuits, the proxy battles with the banks, the fixed legal terms of the board.
The new owners are spending all their energy fighting in court just to get the keys to the building.
Exactly. The transaction costs of changing control are so high, and the political compromises required are so heavy that the new owners simply cannot clean house efficiently.
They have to strike deals with the old board or the banks or the labor unions just to get anything done.
Because of that friction, the bad managers actually survive longer during a takeover than they would have in a stable company that just missed its earnings target.
Wow. So what does this all mean? What is the grand synthesis of Franks and Mayer's deep dive?
The German case proves that there is more than one way to build a functional, highly efficient capitalist empire, even if the mechanics seem completely backward, contradictory, and hypocritical to the rest of the world.
The US and the UK rely on violent, public, hostile takeovers to ensure efficiency. It is loud, it is public, and it theoretically treats all shareholders equally through mandatory bid rules.
But Germany achieved world-dominating industrial efficiency using a totally different engine. They relied on a quiet, tightly knit network of massive holding blocks.
And they relied on a secret, raging underground river of private share trades to reallocate assets.
And most importantly, they relied on a cold-blooded, automatic firing mechanism based strictly on the accounting sheets, the red line.
And they executed that discipline entirely independently of who actually owned the shares.
It was a bizarre, highly engineered balance. They achieved incredibly stable management horizons, which allowed companies like Bosch and Daimler to plan for decades instead of quarters.
And they achieved massive private benefits and wealth generation for the elite families and banks who held the keys.
But they achieved it completely at the expense of the minority shareholder. The small investor was legally blindfolded, blocked by proxy banks, and financially sidelined from the true value of corporate control.
He was a hyper-efficient manufacturing engine built on a profoundly unequal financial foundation. Franks and Mayer proved that the Anglo-American model is not the only way to win. The German insider system worked. It produced an economic miracle.
But it worked through shadows, pyramids, and legal walls.
So let's wrap this up. We have been on a massive conceptual journey today. We started with a quiet stock market that somehow produced a booming global economy. We explored cascading pyramids that, surprisingly, didn't actually monitor managers any better than dispersed crowds.
We met massive proxy banks that didn't act to protect the little guy.
We saw backroom deals that legally allowed elites to extract huge premiums while leaving minority shareholders with nothing.
And we saw that despite all of this legal friction, despite the chaos of block trades that actually protected bad CEOs, the underlying system still functioned because bad managers in stable companies got fired purely due to accounting losses.
It is a labyrinth of contradictions.
Yeah.
But looking at this snapshot of the late 20th century leaves me with a final lingering thought. Something for you, the listener, to mull over as you look at today's markets.
What's the parallel?
We look back at this German system and think it's an artifact, a relic of bearer shares and bank vaults and old industrial families.
Right.
But look at today's hyper-transparent, digitally connected global market.
Hmm.
Look at the modern tech conglomerates. We have founders issuing themselves dual-class voting shares,
Yeah.
where their stock gets 10 votes and yours gets 1. We have algorithmic trading and hidden data monopoly.
It's true.
In a world where every retail investor has a trading app on their phone, are we really operating in a pure outsider-free market? Or are we currently building new, invisible digital pyramids of control that we won't even have the tools to understand for another 20 years?
That is the essential question. The legal mechanisms change, the technology evolves, but the desire for elite control without proportionate financial risk never disappears. It just finds new plumbing.
Thank you for joining us on this deep dive into the source material. Question every obvious economic truth you hear. The real story is never on the public charts. It's always hiding in the plumbing.